My name is Muhammad Ani Gufron, a senior year IPMI BBA student, and I would like to explain about the international finance with Professor Roy Sembel as my lecturer and the one who provide me with all the material in international finance class. In this explanation, I make it more simple and easy to digest. The first variable in this mind map is overview of international finance. International finance deals with financial interaction between countries and global markets. It includes foreign exchange market, international capital market, investment across border, trade finance, global economic institution, risk management, and regulatory frameworks. Understanding international finance is crucial for business, government, investor, and financial institution operating globally, as it helps navigate opportunities and challenge in the international finance landscape. So, the first branch from overview of international finance is regulatory environment, such as laws, regulation, and policies governing international financial transactions which vary by country and impact cross-border investment, trade, and financial stability. The second one is foreign exchange market, where currencies are traded, facilitating international trade and investment. It involves exchange rate determination, currency conversion, and managing currency risk. The last one, or the third one, is international investment. Involves cross-border investment flows, including foreign direct investment or FDI and portfolio investment. It includes strategies for assessing risk and return associated with investing in foreign market. The second one is arbitrage and forex risk management. Arbitrage in the international capital market relates to exploiting difference in interest rates between countries to profit from currency exchange rate fluctuation. Interest rate parity (IRP) is a theory stating that the difference in interest rate between two countries is equal to the expected change in exchange rate over a given period. The first branch from this mind map is forex risk. This is the risk of financial loss due fluctuation in exchange rate. To manage forex risk, businesses often use hedging techniques such as forward contract, option, futures, and swaps. These instruments help lock in exchange rate, providing certainty in transaction costs and cash flow. The second branch is country risk, that encompasses a political, economic, and social factors that may affect international trade and investment. These risks include change in government policies, regulatory environments, and geopolitical tensions. To manage country risk, businesses conduct through risk assessment, diversify their operation across multiple countries, and utilize political risk insurance or guarantees where available. The third branch is economic exposure, also known as operating exposure, refers to the impact of exchange rate fluctuation on a company's future cash flows, competitive position, and overall value. Managing economic exposures involves strategies such as diversification of markets, pricing strategies, and operational adjustment to mitigate the effect of currency fluctuation on business operation. The third branch from this international finance mind map is foreign exchange market and exchange rate determination that we already have studied from MESA case study. Forex market is where currencies are traded globally. It's the largest and most liquid financial market, facilitating international trade and investment. Exchange rate determination in the forex market is influenced by the supply and demand dynamic for different currencies. Factors such as interest rate, inflation, economic growth, geopolitical event, and market sentiment affect currency demand and supply, leading to fluctuation in exchange rates. Central banks also play a role through monetary policy decisions that impact interest rate and currency values. Overall, exchange rate in the forex market are determined by a complex interplay of economic, financial, and geopolitical factors. The fourth branch is parity framework. The parity framework refers to a set of theories in international finance that provide insight into the relationship between exchange rate, interest rate, and inflation rates across different countries. The main concept within the parity framework is PPP and IFE. What is PPP? PPP is purchasing power parity. Assert that in the absence of transaction costs and trade barriers, identical goods should have the same price in different countries when expressed in a common currency. This theory implies that exchange rate should adjust to equalize the purchasing power of different currencies. And we also have IFE, or International Fisher Effect. It's not a fisherman, but IFE combines PPP in IRP theories to suggest that nominal interest rate in different countries reflect both the real interest rate and expected change in exchange rate. It posits that nominal interest rate adjusts to compensate for expected change in exchange rate to maintain purchasing power parity. The fifth branch is exchange rate forecasting. Exchange rate forecasting involves predicting future movement in currency exchange rates. While it's notoriously difficult to forecast exchange rate accurately due to complexity of factors influencing currency markets, various methods and approach are used, technical and sentimental. The technical analysis use historical price data, trading volume, and chart pattern to identify trend and predict future exchange rate movement. Techniques include trend analysis, moving averages, and chart patterns like support and resistance level. The sentiment involves gauging market sentiment and investor psychology to anticipate currency movement. Sentiment indicators, such as surveys of market participants, expectation, and positioning data from futures market, can provide insight into market sentiment. And a lot more actually. Despite advances in forecasting techniques, exchange rate forecasting remains inherently uncertain due to the influence of unpredictable factors such as geopolitical event, back again, market sentiment, and unexpected economic development. The last branch of international finance is EMH, or the efficient market hypothesis. Is a theory in finance that suggests that asset prices reflect all available information. According to this theory, it's impossible to consistently outperform the market because assets price already incorporate all relevant information, making it impossible to predict future price movement. We have weak form efficiency, strong form efficiency, or in the middle, semi-strong form of efficiency. In a weak form efficiency, all past prices and trading data are reflected in current asset prices. Technical analysis, which relies on historical price data, would not be effective in consistently beating the market. And in the strong form, all information, whether public or private, is reflected in asset prices. This suggests that even insider information will not provide an advantage in consistently outperforming the market. Critics of EMH argue that markets may not always be perfectly efficient due to factors such as behavioral bias, informational asymmetry, and market frictions. However, EMH remains a fundamental concept in finance and it's widely studied and debated by academics and practitioners alike. So here's my mind map of international finance class. I'm Muhammad Ani Gufron.